Welcome to the deep dive video update. This is a video that I do every week, and I want to explain my concept of deep dive. There are a lot of different charts that I look at, and some come and go in the daily videos. Well, I don't use all those charts every time, and so the charts that I'm not really looking at right now, I put into this video. And there are also some different charts that I show only in this video, and we have to look a little bit deeper to see, are we getting any insight from these additional charts? And that's why I call this the deep dive video update. This is being prepared for Monday, February 10th. The first chart is a chart of the VIX. You can't see the VIX on here. It's turned invisible, but over top of the VIX is a 50-period moving average. And when the market is under pressure and going down, the VIX is in a higher range. When the VIX is going down, that means stocks are going up and we get into a lower range, and that's where we're at right now. So we mainly just use this for informational purposes, just to see what is the overall range of the VIX itself. Also, closely tied to that is another indicator called the Ulcer Index, and this was developed to mainly work with mutual funds that only have a closing value or a net asset value. And this measures fear. When this is going up, that means there's a lot of fear in the market. When it's going down, that means there's not as much fear. I usually only show this chart in the daily video when we get above the moving average, and we're kind of close to that right now. So if we continue to see more weakness in the market, this will probably go up, and I'll probably start showing that in the daily video again. Another study is a correlation between the VIX and the S&P 500. We're getting a very low reading right now, so that's why I haven't been including this chart. If this really spikes up and goes above the dash line, that means that fear is coming into the market that we may not be picking up with other charts. Also, we do a ratio between the VIX and then like an indicator of the VIX called the VVIX or volatility of the VIX. It's just chopping sideways right now. Excuse me. It's just chopping sideways right now. In a general sense, when the market is going up, the VVIX or VIX to VVIX ratio will go down. And then when this ratio is going up, that means the market's under pressure and going down. That just means the VIX is moving faster or slower than the accompanying volatility of the VIX. Also, we want to keep an eye on the speed of the VIX, and I use an RSI based on 9 periods to do this. I only show this chart if we get extreme positive or negative. Right now, we're in the middle, so I haven't been showing this chart. And then we look at the volatility of stocks as measured by the VIX and the volatility of bonds as measured by the MOVE index and plot that in a ratio. And in a general sense, when this line is going up, that's what I follow, is the red line. It's a 50-period moving average. And sometimes this can give us some insight. When this is going down, that meant here that the S&P was going up. Also, when it was going down here, well, we're kind of drifting a little bit higher as we're seeing an overall change in the climate right now as the new administration comes in and enacts all these changes. And the market's been a little on edge as far as, okay, what's going to happen with interest rates, what's going to happen with inflation, what's going to happen with tariffs and things like that. But we've kind of been going sideways here, so we're not really getting a lot of insight from this particular chart. And then this comes and goes out of the daily videos and then back in. This is a risk on to risk off ratio, and we're not seeing an awful lot of conviction right now, so I stopped using it in the video, at least for right now. What we're looking for is some kind of a blatant move up or down. When we're going up, that means the market is more risk on, and we're probably going up at that time. And when this is going down, that means more risk off or getting into stocks that tend to hold up better when the market's under pressure. We're not really seeing much of anything right now, so I haven't been showing this chart. And then we look at a ratio between large caps as measured by the Russell 1000 and small caps as measured by the Russell 2000. The Russell 1000 is kind of the equivalent of the S&P 500, and we've just been chopping around right now. Small caps have really been disappointing. Again, they were a year ago because usually December into January, going into the early part of the year, that's when small caps are supposed to shine. Well, they didn't a year ago. They looked like they were getting ready to really move, and then they would go up and drop back. We're kind of seeing that same thing now, just kind of chopping sideways. And then the larger market has also, it's doing well and holding up, but it's not necessarily outperforming. So we're not seeing a real change in this ratio overall. Then this is more for informational purposes. We go back to the low that was set in October 2022. That was the cyclical bear market low. And then where are we as of Friday's close? We're still up 72.44% from that low. And then we had another major low in October 2023, and we're up 46.84% from that level. Stockcharts.com, every week they come out with technical alerts, and you can see that you go mainly by the color here. If we're having a positive day, we're seeing a lot of blue or green. If it's a negative day, we're seeing a lot of red. And you can kind of just see this by looking at the colors overall. And we've been really choppy lately. And so we really haven't been getting a lot of conviction one way or the other. Then there's now six indexes. I used to do five, but I added the NASDAQ composite. And stockcharts.com tries to remove all the emotion by ranking these charts, just looking at their technical analysis scores and giving them a scale of 0 to 100. The higher the score, the better looking the chart. I take those six indexes and then say, okay, what's doing the best and what's doing the worst? Well, coming in first place are the QQQs. They're still holding up quite well. Now, when the Qs are really strong, when any index is strong, we'll get into the 90s with this score. And we're doing okay right now, but not great. And we're coming in with a score with the Qs of 83.2. So if this shows some improvement, we'll see this number go up. Then in second place is the NASDAQ itself. This is one of the newer indexes that I added to this particular start of the video. Because going back to last summer in 2024, the QQQs, which is the NASDAQ 100, it was outperforming the NASDAQ because we had the Magnificent Seven stocks and the stocks that really drive the market. Well, they started to lag behind near the end of summer, going into the fall. And the NASDAQ, which is a broader index, actually started to outperform the NASDAQ 100. I thought, okay, maybe we should include that here. It's still doing quite well, but it's coming in second place this week at 82.1. Then in third place is the Dow. Now, the Dow is only 30 stocks, and it's not one that I follow all that much. We still keep an eye on it because most people, they use this as a benchmark to say, okay, the Dow's up, the Dow's down. So I also include it for that reason. So it's not as really broad. I like the S&P 500 myself. It's 503 stocks, where there's only 30 stocks in the Dow. It's coming in with a score this week of 78.5. Then we have the S&P itself, and it's been chopping around, not really trending at all right now, either in the short, intermediate, or you look at the weekly chart and it's not trending currently as things have been chopping around. But it's still holding up okay, coming in at 77.1. Then we have the small caps, which have been frustrating not only a year ago, but they're kind of frustrating now. We're hitting overhead resistance, and there are two small cap indexes that I look at, the S&P 600, and then this is represented by the IWM, the Russell 2000 small cap index. That's probably the most popular. And so we just use this to get an idea of where are the small caps in relation to the other indexes. They're coming in at 58.3. Then we have the mid caps, which actually showed a little bit of strength this past week, not not in the index itself, but we look at growth to value ratios. And when growth is outperforming value, that's really positive for the market. When value is outperforming growth, that's more negative or it's getting more defensive. And we've seen the growth to value ratio really moving up this past week, but it's not being reflected in the index itself. So it's coming in with a score of 57.7. Then some short-term charts. Here's a rainbow going from 10 periods up to 50 periods. We can see we're still above the rainbow. We're getting really choppy right now, and the lines are kind of moving all around with each other. but we're still maintaining price above these different moving averages. Then this comes and goes out of the video too. This is an advanced decline ratio, and this is more short term. It's based on 19 periods. I have another chart that I show every day that's based on price. And even though we're coming down, we're still above zero. So this is positive. But this chart also uses volume, and we're actually starting to drop below zero here based on volume. If we continue to see more weakness like that, I'll put this chart back in the daily video just to give some perspective. And that's what we're seeing right now. A lot of times over the last number of months, if we see volume doing better than price, that's more positive. We're possibly going into a time right now where we're seeing volume underperforming price, and that could be more negative for the market. Then we want to measure how far away are we from various moving averages. In the short term, we have a 20 period moving average, and then intermediate term is 50, and long term is a 200. And this is called the boom indicator, and it just measures where is price in relation to these moving averages here. Because when we get too far away from that moving average, price has a tendency to revert back to the moving average. And we're not getting any kind of an extreme reading right now. But when we're really moving and either up or down, I show this chart pretty much every day. But since we've been just chopping around, there's been no need to show this chart because we're not really moving with any real conviction. Then another rainbow going from 50 periods up to 100 periods. We're still above all the lines. The lines continue to be flat. So for the time being, the short term's been choppy a little bit and the lines are crossing over each other. But here in the intermediate term, the lines are still flat and going up. Bollinger Bands, there's a lot of different ways that you can use Bollinger Bands for analysis of the market. This is just one particular way. This is called the percent B indicator, and it measures when we're above or below the upper or lower Bollinger Band. We're not there now. And I only show this chart if we're getting some kind of an extreme reading. Then we want to keep an eye on how far away are we from the 200 period simple moving average. That's the long-term trend. And we're above it. And so we're green here. We're falling back a little bit. But you might want to be tempted to say, well, look at this. We were up here and now we're down here, but the S&P has been going up. That's a negative divergence. That's not actually accurate because the moving average changes. It's going up too. As long as we're above the 200-day moving average, the moving average is going to continue to go higher and it's going to produce what you might think is a negative divergence here when really that's not what it's showing. But we just keep an eye on this to know more of what the long-term trend is and where the S&P is in relation to that long-term trend. Also, some measurements here, and I eyeball this, so the percentages are probably going to be kind of crazy. This goes back to the October 2023 low that I mentioned earlier, and then where are we in relation to that as of Friday's close? Also, when we look to do declines here, we keep an eye on the percentage because the market pays attention to that. If we set a high and then we start to retrace down, if we get around the 10% level, if we're going to bounce, that's usually a good place to bounce. If we fall below that 10% level, that's meaning that will mean that things are turning much more negative. So I have one here that happened back in 2024, and then we were coming down here at the end of 2024 into 2025, but now we're just kind of chopping along sideways. Another momentum oscillator is the Connors RSI. We use it like a regular RSI. It's pretty touchy here on a day in and day out basis, but we don't get very many extreme positive or negative readings. So when we're not getting those, I don't show this in the daily video. Then here's some anchored moving averages, which try to project forward with support or resistance levels. Since we're going up here, these are mainly support levels. The takeaway from this is all of these lines, whether they're long term or shorter term, continue to go up. And that's suggesting that the longer term trend is still positive. And the short term trend and intermediate term trend are also positive. The composite index, I use this again like an oscillator. We look for extreme positive or negative readings. We're not getting one right now. Then we've been watching the 20 period moving average. That's short term, and I show that in the daily videos. Well, we are seeing some declines, and we actually started to test the 50 period moving averages. So that's back in the daily video right now. Well, the next layer down, if we continue to see more weakness, would be the 100 period moving average. We're still well above it right now, and all the lines are still going up. But if we do see more weakness, this one will probably be watched. Back in January, we came down. We're having some difficult times, but this 100 period moving average held for 3 days in a row, and then we were able to break up out of that. And then we have some news that hits, and then we gap lower and come back, and then gap lower and then come back. And that's why we're seeing this real non-trending environment currently. Then we keep an eye on the S&P 100 and compared to the S&P 500. Now, in the intermarket analysis video that I do, we're showing that the S&P 100 is not really performing all that better than the S&P 500, which has not been the case over the last couple of years. Now, we don't know if this is a short-term thing that will eventually work itself out, and the bigger stocks, which make up the S&P 100, will start to outperform the rest of the S&P 500, or if we're seeing a general shift. We're not seeing that with other indexes like the NASDAQ 100. That's still holding up fairly well. So we'll be keeping an eye on that to see if there's a real change here. But we look at this chart to see are there really any divergences happening? And they're not on a price basis. It's other analysis that's done to show us, okay, which is outperforming the other. And standard deviation, I only show this when we're above the moving average. This measures speed, not direction, but just speed. How fast are we moving? And we're really dropping down now as we've been pretty choppy. Then a long-term rainbow going from 50 periods up to 250 periods. We're above all the lines. The lines are still going up. The long-term trend is still positive. Then another long-term oscillator is called the special K. This is a daily chart. I also show a weekly chart. We're positive on the weekly chart and we're positive here on the daily chart. Since we don't see many signals with this chart, I don't show it in the daily videos. Then we look at the relationship between US stocks and European stocks, specifically the German DAX, which is doing really well now. It's breaking out and setting recent all-time highs where the S&P isn't. And so we're seeing a little bit of a deterioration of the correlation between US and European stocks here. And we'll keep an eye on this to see because a lot of times Europe tends to lead the US economically and based in fashion and even technology, believe it or not. So we'll see. Is this positive action that we're seeing in Germany right now, is that going to eventually help the US markets? Then some support and resistance levels. These are fib retracement levels going back from the all-time high that was set in earlier on in December. And then if we do start to really decline, we'll be watching these different fib retracement levels here, but we're far away from them right now. And then this comes and goes out of the daily video. There's the Ichimoku cloud. When we're declining, at least in this context, and we come back down into the cloud, we're wanting to see is the cloud going to provide some kind of support? Just like when we're going down and we start to bounce, is the cloud going to provide some kind of resistance? And also, the takeaway is that the cloud is green right now, and that tends to be more positive. And really, all this cloud is just a series of moving averages that are shifted forward and used as an area of support or resistance to try to determine what's happening with that. Well, there's also some studies here that are more trend based. And we have a green line that's a little harder to see. It's been really choppy lately, but we see the blue line above the red line, so that is more positive. Then we look at the Vixen, which is the volatility measure for the NASDAQ 100. I don't focus on that as much because I mainly focus on the S&P 500, but it's a good idea to keep an eye on this one. And then we look at a ratio between the weighted version of the S&P and then an equal weight version of the S&P. Not an awful lot of conviction happening right now, so I haven't been showing this chart. And then we look at the S&P on top and then a ratio between growth, the NASDAQ 100, and value, the Dow, and then do a correlation between the top chart and the ratio of the middle chart. It's coming down a little bit as we're just not seeing a lot of conviction in the market right now. And we want to keep an eye on the relationship between the Dow and then the Dow transports. And when the black line is the Dow, and it's clearly been outperforming the transports as they've been just going sideways lately. And we want to keep an eye on the financial sector in the bigger picture, and then the regional banks in a little bit smaller context, and then do a ratio between the two. Not really showing any strength, but not showing an awful lot of weakness right now. And I was really focused on this for a while. This is the bank ETF. We want the banks to do well in a more positive environment. If they start falling apart, that's what we saw back in late 2007 going into 2008, which was the great financial crisis. So we keep an eye on those charts. Now, the reason I was focused on this lately is that we were having a hard time getting above the 50-day moving average with the bank ETF. Well, we've been able to get above that and stay above that, so that's keeping things a little bit more positive. And we look at a staples to tech ratio, not showing an awful lot of conviction right now. When this is going down, that means staples are underperforming. When this is going Yeah, when this is going down, staples are underperforming. When this is going up, that means staples are outperforming. But we're just kind of not really showing an awful lot of conviction so far in 2025. Then we keep an eye on the QQQs, which is the ETF for the NASDAQ 100. I was showing this video when we were dropping below these 20 and 50 period moving averages. Even though we declined on Friday, we're still above all these moving averages, and for the most part, the moving averages are going up. So that's still positive. If we start to drop below this, then I'll put this chart back in the daily video. Rate of change charts, these are just for information. These are very long term, going back 250 periods, where we have been declining here with this chart, also coming down below the blue line. We're still seeing other long-term measurements looking okay, but if this really starts to drop, this takes Friday's close and goes back 250 periods and compares the price with each other. And it could be more negative if this keeps going down, but other things that we look at are still holding up quite well. And we want to keep an eye on bonds. And I actually show this in the what to watch video because this is the third area of that video where I'm just watching something and we're not positive, we're not negative, we're just observing what's going on. And we're seeing a real change going on here when we compare cash with the 3 to 7 year bond. When this is going up, that means cash is outperforming bonds. Bonds have been under pressure lately. When bond prices go down, that means interest rates go up. And we're still coming down a little bit here as interest rates are coming back down. But if this turns and goes back up, that would probably be more negative. We look at TIPS, which are Treasury inflation protected securities, and compare them with more conservative fixed yield 3 to 7 year bonds. And when this is going up, that means the market's getting a little bit more concerned about inflation and interest rates. Well, we have been going back up lately, even though we're in a downtrend with this ratio. And in Friday's session, the consumer sentiment came out, and one of the components of that is there's a fear of inflation going forward from here with all the tariffs and all the changes and things that are happening. We'll have to see if this continues to go up. That means there's more fear going on, and that could pressure stocks. If this starts to come back down, that would be more positive. And then do that same thing. We look at tips and then look further out with 7 to 10 year bonds. This is also continuing to go up, which means that inflation concerns may be starting to come back in and have been now going into last fall in 2024 and continuing through into 2025. We look at the long-term bond ETF and then the S&P 500 and look at correlations between the two. The long-term correlation is pretty much flat right now, and we're seeing a little bit of a strengthening of the short-term correlation, just meaning they're going in the same direction at the same time, whether up or down. That same thing is applied to the QQQs in the long-term bond, pretty much neutral right now with the correlation as the market's figuring out what kind of an environment it wants to shift into. Then another look internationally, we look at the 10-year yield in the US and subtract the German 10-year yield. And then down here we plot the US dollar index. And as strange as it may sound, it shows the interrelation between currencies and yields because here's the dollar and you can see that there's a pretty high correlation between the two. When this really gets out of line, that's when we take a little bit more notice of this. But consistently, we've seen that there's a pretty strong correlation here. Then we just keep an eye on the 2-year treasury yield. That's shorter term. Not really getting much insight from this right now. And we look at the Eurozone because we want to keep an eye on the interplay between Europe and the US. And Europe's been doing really well, and we're coming out of the rainbow, meaning the Eurozone ETF is outperforming American 3 to 7 year bonds. Then I have a number of things called possible positive scenarios. I really brought these out and used them back in 2022 when we were going through that real downturn in the market. Because sometimes when we've been going down, we bottom and then see some kind of a bounce. Well, some of those charts I still use in the daily videos. Other charts I show here. This is the percent of stocks in the S&P above their 200-day moving average. I use this like an oscillator. We look for an extreme positive or negative reading, not getting that now. And then what is the general context of this chart? If we're above 50, we're more positive, and we are above 50 now. That same basic idea applies to stocks above their 50-day moving average. We are coming down. We're getting close to that 50 level. If we drop below 50, that would turn this more negative, but we're not getting any kind of an extreme positive or negative reading. Also declining a little bit more here with the mid caps, not getting an extreme positive or negative reading. And the small caps also showing some weakness right now. So this is telling us that overall, in a little bit bigger picture, especially the small caps and the mid caps are not really performing all that well. But the S&P is holding up. But if we see further weakness, that would turn things more negative. And we look at a ratio between staples and the S&P. Staples are more defensive. They outperform when the market's going down, like we saw back in 2022. But when this is going down like it is now, and for the most part it's been going down, that means the S&P is outperforming. But we've been just chopping around lately, so I haven't been showing this video. All right. Thank you. I hope you found this helpful. Have a really good weekend. Enjoy the Super Bowl, and I will talk to you in the next video.